The most respected economics professor at Harvard confidently tells his students that markets are always efficient, using George Soros as proof. When Soros quietly raises his hand from the back row, the next 90 seconds don't just prove the professor wrong, they expose that everything these future economists learned is backwards. Cambridge, Massachusetts, April 1994. A Thursday afternoon economics lecture in Harvard's Littauer Center, the most intimidating classroom in American academia. High ceilings, dark wood paneling, portraits of long-dead Nobel laureates staring down from the walls like stern judges evaluating every word spoken below. 200 students packed into tiered seating, notebooks open, pens ready, hungry to absorb wisdom from Professor Edmund Hartwell, the most respected economist at Harvard, maybe in America. Professor Hartwell is a legend. 63 years old, silver hair, perfectly styled, wearing a navy blazer with elbow patches that cost more than most people's cars. PhD from Cambridge, visiting professor at Oxford, advisor to 3 presidents, author of the definitive textbook on market efficiency that every economics student in America has to buy for $300 and pretend to understand. When Edmund Hartwell speaks, future Treasury secretaries listen. When he writes, Federal Reserve governors take notes. When he teaches, he shapes the minds that will run global finance for the next 30 years. Today's lecture is about market efficiency, Professor Hartwell's specialty, his life's work, the theory that made him famous and wealthy, and invited to speak at central bank conferences around the world. He stands behind the podium like a general commanding troops, pointer in hand, addressing his army of future economists with absolute confidence. On the blackboard behind him, elegant equations capture the mathematical beauty of market behavior. Supply and demand curves intersecting at perfect equilibrium, the invisible hand of the market guiding prices to their rational, efficient level. The efficient market hypothesis, Hartwell explains to his rapt audience, is the foundation of modern finance. Markets process information instantly and perfectly. Prices reflect all available knowledge at all times. No one can consistently beat the market because any edge gets arbitraged away immediately by rational actors seeking profit. It's mathematically proven, empirically tested, theoretically sound. The market is rational because it has to be rational. If it wasn't rational, smart people would notice the discrepancies and fix them through trading, forcing prices back to their correct levels. The students scribble notes frantically. These are Harvard students, the best and brightest, future masters of the universe. They're here to learn the secrets of wealth creation, the mathematical formulas that govern global capital flows. They believe Professor Hartwell completely. Why wouldn't they? He's published in every major economics journal. He's testified before Congress. He's consulted for Goldman Sachs and JP Morgan. If anyone understands how markets work, it's Edmund Hartwell. But today, something is different. Something that makes this Thursday afternoon lecture historic. In the back row, sitting quietly, taking notes in a small notebook with a fountain pen, is George Soros. The George Soros, the Hungarian immigrant who survived Nazi occupation as a teenager, who worked as a waiter in London to pay for his education at the London School of Economics, who built a small investment fund into a global empire, who made $1 billion in a single day betting against the Bank of England, the man who broke the pound, who crashed currencies, who made more money than any investor in history by understanding markets better than the people who built them. He's 64 years old, lean and sharp-eyed like a bird of prey, wearing a simple grey suit that probably costs more than most people make in a year but doesn't announce it. His famous white hair is slightly disheveled, like he's been thinking hard about something complex and unsolvable. He's holding a Mont Blanc pen that he twirls between his fingers when he's processing information, a habit developed over decades of making billion-dollar decisions. Most students don't recognize him. To them, he's just another old guy auditing a lecture, probably some emeritus professor or wealthy donor checking up on his alma mater. But he's here for a reason. Harvard invited him as a distinguished guest, a chance for students to meet the most successful investor alive. What they don't know is that they're about to witness the collision of theory and reality. Professor Hartwell continues his lecture, building methodically to his main point. The reason markets are efficient, he explains, is that smart money eliminates inefficiencies faster than they can persist. When prices deviate from fair value, arbitrageurs step in and correct them through trading. It's self-reinforcing and self-correcting. The market teaches itself to be rational through the profit motive. Even the most successful investors, Hartwell says with a slight smile, succeed not by beating the market, but by taking on appropriate risk. They get paid for risk, not for superior knowledge, because superior knowledge doesn't exist in an efficient market. The market already knows everything worth knowing and prices it in immediately. Think about it logically, Hartwell continues, warming to his favorite theme. If markets were inefficient, if there were easy profits just lying around, wouldn't everyone grab them? Wouldn't smart money flow to exploit these opportunities until they disappeared? The very act of seeking profit eliminates the profit opportunity. It's beautiful, really. The market's self-correcting mechanism ensures that prices reflect true value. Then he makes a mistake. A professor's mistake. The kind that feels safe in a classroom full of agreeable students, but dangerous in the real world where theories meet reality. He decides to use George Soros as an example. Take George Soros, Hartwell says, warming to his theme, gesturing with his pointer like he's conducting an orchestra. Arguably the most famous investor of our time, made billions of dollars, featured on magazine covers, called the man who broke the Bank of England. But here's what people don't understand. His success doesn't disprove market efficiency, it proves it. Soros took enormous risks betting against currencies. He got lucky on timing. But for every Soros who got rich taking currency risk, there are dozens of investors who lost everything making similar bets. The market paid Soros for taking risk, not for being smarter than everyone else. His returns, adjusted for the enormous risk he took, are actually quite normal. He's proof that the market works exactly as theory predicts. The room nods in unison, 200 future economists absorbing this wisdom, this elegant explanation that makes everything make sense and fit into neat mathematical models, random chance disguised as genius. Risk premiums disguised as alpha. The market working exactly as the equations predict, rewarding risk-taking but not skill, because skill in beating the market is impossible by definition. That's when George Soros raises his hand. A quiet gesture, nothing dramatic, just an old man in the back row with a question, the way thousands of students have raised their hands in this classroom over the decades. Professor Hartwell notices, squints slightly, doesn't immediately recognize him. Yes, you have a question? Soros stands up slowly, unfolding his tall frame from the cramped lecture hall seat, still holding his notebook, still twirling his pen. His voice carries clearly through the lecture hall, Hungarian accent still present after 40 years in America, still marking him as an outsider in the American academic establishment. Professor Hartwell, I'm George Soros. The room goes dead silent, 200 students turning in their seats, necks craning, trying to get a look at the legend in their midst. Whispers ripple through the crowd like wind through wheat. That's really him. Oh my God, this is going to be good. Professor Hartwell's face goes through several expressions in rapid succession. Surprise, recognition, a flash of panic quickly suppressed by academic training. He just spent 10 minutes explaining why George Soros isn't actually special, using George Soros as an example of how the market works efficiently, to George Soros's face, in front of 200 witnesses. Mr. Soros? Hartwell recovers quickly, professional smile returning like armor. What an honor to have you here. I hope you found my analysis of your success educational. I did, Soros says mildly, his tone giving nothing away. But I have a question about your fundamental premise. Of course, please. Hartwell gestures magnanimously, like he's granting permission to speak in his own classroom. You say markets are efficient because arbitrageurs eliminate inefficiencies, that prices reflect all available information at all times, that success comes from risk-taking, not superior insight into market behavior. That's correct. The mathematical proof is quite elegant. But what if? Soros interrupts gently, his voice still quiet but somehow filling the entire room. The participants' beliefs about the market actually change the market itself. Professor Hartwell pauses. The question doesn't fit the framework. It's like asking what color mathematics is. I'm not sure I follow. Soros walks slowly down the aisle toward the front of the classroom. 200 students watching his every step like he's walking to a duel. When he reaches the front, he turns to face the class. Professor Hartwell steps aside, suddenly feeling like a student himself, like he's lost control of his own lecture. Let me tell you about the 16th of September, 1992, Soros says quietly, his voice carrying the weight of lived experience. Black Wednesday, the day I supposedly got lucky betting against the pound. The room is absolutely silent. This is it. This is the story. The most famous trade in history, being told by the man who made it, in real time, to future economists who will study this trade in their textbooks for decades to come. The British government joined the European exchange rate mechanism, Soros continues, his hands moving as he explains, drawing invisible diagrams in the air. They committed to keeping the pound within a narrow band against the Deutschmark. John Major's government staked their credibility on this commitment, but there was a problem. British interest rates were too low to support that exchange rate given the economic fundamentals. German rates were higher. Capital flows were inevitable. The math was simple. Either rates had to rise dramatically, or the pound had to fall. There was no third option. Professor Hartwell nods vigorously. This fits the theory perfectly. Fundamental analysis, information processing, rational arbitrage based on interest rate differentials. But here's what your theory misses, Soros says, and his voice gets quieter, making everyone lean in, creating a bubble of intimacy in the large lecture hall. My selling pressure wasn't just exploiting an existing inefficiency, it was creating one. Every £1 billion I sold made the Bank of England's position more unstable. Every hour they spent defending the pound cost them reserves they couldn't afford to lose. Every public statement about their commitment made them look more desperate. My attack made their commitment less credible, which made other investors join the attack, which made their position even less credible. He walks to the blackboard, picks up chalk like he owns the classroom now, draws a circle with arrows pointing both ways, creating a feedback loop that spirals outward. This is reflexivity, he says, tapping the diagram. The participants' beliefs affect the outcome, which affects their beliefs, which affects the outcome. Markets aren't just discounting the future, they're creating it. The prediction becomes the reality. Professor Hartwell looks confused, like someone just told him that gravity works upside down. But that's just a feedback loop. The market still tends toward equilibrium through arbitrage. Does it? Soros interrupts, not harshly, but with the patience of someone who has tested these theories with his own money. He writes a date on the board. The 19th of October, 1987. Stock market crashes 22% in a single day, biggest one-day drop in history. What new information justified that? What fundamental change in corporate earnings? Or was it fear feeding on fear, selling causing selling, until the feedback loop broke the market? The students are scribbling furiously in their notebooks. This isn't in the textbook. This is real experience, challenging academic theory. Another date, 1989. Japanese real estate bubble peaks at valuations that made no mathematical sense. The Imperial Palace grounds in Tokyo were worth more than all the real estate in California. Efficient market pricing? Or speculation feeding on speculation, prices rising because rising prices attracted buyers? A third date, 1997. Asian financial crisis. Thailand, Indonesia, South Korea, collapse in sequence. Contagion spreads, not based on fundamentals, but on panic. Each collapse makes investors pull money from the next country, creating the conditions for the next collapse. Let me ask you something, Professor, Soros says, turning back to Hartwell, with the gentle directness of someone who has made and lost fortunes based on understanding reality. If markets are perfectly efficient, if all information is instantly reflected in prices, how did I make $1 billion in a single day? What risk premium justifies that return? Currency risk. Hartwell answers quickly, grasping for the familiar framework. Exchange rates are inherently volatile, and you were compensated for taking that risk. I wasn't taking random currency risk, Soros cuts him off politely but firmly. I was creating a self-fulfilling prophecy. I identified a government commitment that was mathematically unsustainable given the economic fundamentals, then made it politically unsustainable by attacking it. The attack itself was the catalyst that triggered the outcome I predicted. He draws another diagram. Government commitment versus market pressure. Shows how pressure grows exponentially once credibility breaks, like a dam bursting. Your theory assumes the future is independent of our expectations about it. But in financial markets, expectations become reality. If enough people believe a currency is overvalued, their selling makes it overvalued. If enough people believe a bubble is forming, their buying creates the bubble. The observer changes the observed. This isn't physics, Professor. This is social science disguised as natural science. Professor Hartwell is scrambling for a response, his worldview cracking like ice in spring. This challenges everything he's built his career on. But, over long time horizons, markets do converge to fundamental value. Short-term noise gets smoothed out by rational actors. By when? Soros asks, his voice still gentle but relentless. After how many people lose their life savings? After how many currencies collapse? After how many booms and busts destroy real wealth and real lives? And who decides what fundamental value means when fundamentals themselves change based on market behavior? When companies go bankrupt because their stock price falls, making it impossible to raise capital, was that fundamental value or self-fulfilling prophecy? 90 seconds. That's how long it took. 90 seconds to dismantle 30 years of academic theory in front of 200 future economists. 90 seconds to show that elegant mathematics might miss the most important truth about markets. They're made of humans, not equations. The room is silent. Professor Hartwell has no answer. His elegant equations suddenly look inadequate, like tools built for a perfect world that exists only in textbooks and academic papers. Soros puts down the chalk, walks back toward his seat, but he stops, turns around one more time, looking directly at the students now instead of their professor. Professor, you said I got lucky betting against currencies, but I've been making money in markets for 40 years. I've profited from the collapse of the pound, the bubble in Japanese stocks, the Asian financial crisis, the dot-com boom and bust. How long does luck last? Maybe, just maybe, there's something your theory isn't capturing about how markets actually work. He sits down quietly. The lecture is over, even though 20 minutes remain on the clock. Professor Hartwell tries to continue, attempts to regain control of his classroom, but the energy is gone. The spell is broken. The students aren't listening anymore. They're thinking, processing, questioning everything they thought they knew about markets, about economics, about the difference between theory and reality. After class, a line of students forms outside Soros's hotel. They want to understand, want to learn, want to know if everything they're being taught is wrong, if their expensive educations are preparing them for a world that doesn't exist. Sarah Chen, a first-year graduate student from Beijing, asks the question they're all thinking. Mr. Soros, should we drop out of economics? Are we wasting our time learning theories that don't work? Soros smiles, the first genuine smile of the day. No, learn the theory, understand it completely, master every equation, every proof, every assumption. Then learn why it doesn't work in practice. Study the exceptions, the anomalies, the times when reality deviated from theory. The gap between theory and reality, that's where opportunity lives. That's where fortunes are made. 10 years later, Sarah Chen runs a hedge fund that specializes in emerging markets. She credits that 90-second exchange with teaching her to think for herself instead of accepting elegant theories that don't match messy reality. 20 years later, Professor Hartwell retires. His final lecture includes a section on reflexivity and behavioral economics. He tells students that the greatest learning moment of his career was being wrong in public, in front of the man who proved him wrong, and discovering that being wrong was the beginning of wisdom. 30 years later, Harvard Business School teaches a case study about Black Wednesday. Students learn about reflexivity, about self-fulfilling prophecies, about the difference between theoretical elegance and practical truth. They learn that the most dangerous phrase in finance isn't, "this time is different," it's, "this can't happen because the theory says it can't." George Soros proved that theory serves reality, not the other way around. That understanding how things actually work matters more than understanding how they should work. That 90 seconds of uncomfortable truth is worth more than 90 years of comfortable theory. The market isn't rational. People aren't rational. But if you understand the irrationality, if you can predict how beliefs become reality, if you can see the reflexive loops that connect perception and outcome, you can profit from the gap between what should happen and what actually does. That's what George Soros taught Harvard in 90 seconds, the most valuable economics lesson in the university's history. Not from a textbook, not from an equation, from a man who got rich by being right when everyone else was wrong.